There is a profound and unsettling truth at the heart of the speculative markets, a truth so contrary to human nature that most traders will spend their entire careers and their entire fortunes refusing to accept it. It is this: the instincts that serve a man so well in every other aspect of his life are the very same instincts that will lead to his certain ruin in Wall Street. The impulse to hope when in danger, to seek comfort in the consensus of the crowd, to be brave when one should be cautious. These are the traits of a successful human being, and the certified attributes of a failed speculator. Jesse Livermore did not just understand this truth. He built his entire legendary career upon its opposite. He saw that the market was a grand psychological battlefield, and the most formidable enemy a trader ever faced was the one that resided within his own mind. The average man comes to the market and acts upon his natural feelings. When prices are soaring and the air is thick with tales of fortunes made, he feels an irresistible surge of greed, and so he buys. When his position turns against him and his capital begins to bleed away, he feels a desperate, paralyzing hope that the market will reverse, and so he holds on, a prayer on his lips as his account dwindles to nothing. These are not strategic decisions. They are emotional reactions, and the market is a master at exploiting them. Livermore observed this endless cycle of greed and hope, and he recognized it as the primary engine of the public's perpetual losses. He saw that the market does not beat the average man. The average man beats himself. He brings his own worst enemies to the fight: his vanity, his fear, his greed, and, most destructive of all, his hope. These human weaknesses, he noted, are inseparable from human nature. And it is for this reason that the principles of successful speculation will always be the same. The game does not change because human nature does not change. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The core of Livermore's secret, the number one principle that can stop a losing trader in his tracks, is a concept so radical it sounds like madness. It is the idea of opposite-day trading. This is not a mechanical system for buying or selling, but a profound psychological re-engineering. It begins with a simple, brutal admission. If you are consistently losing money in the market, your instincts are wrong. Your feelings, your impulses, your gut reactions, they are not your allies. They are your betrayers. They are the signals that are leading you directly to the poorhouse. Therefore, the first and most powerful step a losing trader can take is to begin a process of radical self-doubt. When the urge to buy a soaring stock becomes overwhelming, he must pause and recognize that this feeling of intense greed is very likely the same feeling that precedes a market top. When the desire to hold on to a losing stock, to give it just a little more time to come back, feels like a prudent act of faith, he must recognize that this feeling of desperate hope is the classic precursor to a catastrophic loss. His own emotions have become a perfect contrary indicator. This is a difficult and humbling realization. It requires a man to admit that his natural judgment in this specific arena is fundamentally flawed. But for the speculator who is serious about success, this admission is not a sign of weakness but the beginning of true strength. It is the moment he stops being a victim of his own psychology and starts to become its master. He begins to understand that if his every instinct has led him to be on the wrong side of the market, then the path to the right side must lie in the opposite direction. Livermore himself learned this through years of painful trial and error. He lost his first $1 million, and several more after that, precisely because he allowed himself to be swayed by these natural but fatal impulses. He would be bearish on the market, his analysis sound and his reasoning clear, but a sharp, vigorous rally would ignite a flicker of doubt, a fear of being wrong, and he would cover his shorts too soon, only to watch the market collapse as he had originally predicted. He had allowed the market's momentary strength to play on his fear. Conversely, he would be bullish, correctly anticipating a major advance, but would sell out too early, fearful that his paper profits would vanish. Fear, he learned, keeps a man from making as much money as he ought to. He would snatch a small 4-point profit in a great bull market, feeling prudent and conservative, only to watch in agony as the stock climbed another 50 points without him. He had allowed his fear of losing a small profit to cheat him out of a great one. The successful trader, he concluded, must fight these two deep-seated instincts. He has to reverse what you might call his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. This psychological inversion is the essence of opposite-day trading. It is the conscious decision to act contrary to the very emotions that feel most natural and compelling at any given moment. When a trade is going against you, the amateur hopes for a reversal. The professional, practicing this opposite principle, fears that the loss may develop into a much bigger loss. This fear is not paralyzing. It is a catalyst for action. It compels him to cut the loss immediately, to eliminate the danger before it can metastasize. He acts on fear, not on hope, when he is losing. When a trade is going in his favor, the amateur is fearful that his profit will disappear, and he gets out too soon. The professional, in contrast, becomes hopeful. He sees the profit as the market's confirmation of his judgment, and he becomes hopeful that this is the beginning of a major sustained move. This hope gives him the courage and the intelligent patience to sit tight, to ride the trend for all it is worth. This inversion is the key to breaking the cycle of failure. The losing trader must begin to view his own emotional impulses with deep suspicion. When the ticker is screaming, "Buy, buy, buy," and his heart is pounding with greed, he must learn to hear a different message, a quiet whisper of caution. This is the moment of maximum risk, the point at which the market is most euphoric and therefore closest to its peak. The opposite action is not necessarily to sell short, but to do nothing, to refuse to be drawn in by the mania. When his stock has fallen and his friends are telling him to be patient, that it's bound to come back, he must learn to recognize this as the lullaby of financial ruin. Hope, at this moment, is a poison. The opposite action is to sell, to take the loss, to accept the market's verdict and preserve his capital to fight another day. It is to act on the cold, hard reality of the price, not on the warm, comforting fantasy of a miraculous recovery. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvis, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. This process of opposite-day trading is, at its core, a form of mental training. It is a way of breaking the deeply ingrained habits of emotional reaction that cause the majority of losses. It is not a call to trade blindly against every impulse, but to use those impulses as a warning signal, a reason to pause, to reflect, and to consult the cold, objective evidence of the tape. It is to ask, if my greed is telling me to buy, what is the market actually telling me? More often than not, the trader will find that his emotional impulse is in direct contradiction to the facts of the market. The euphoric buying at the top occurs on climactic volume, a sign of distribution, not accumulation. The hopeful holding of a losing position ignores the clear shift in the line of least resistance from upward to downward. By learning to distrust his feelings, the trader is forced to rely on his observations. And it is only through observation, confirmed by experience, that true market wisdom is born. The practical application of opposite day trading begins with the most common scenario for the amateur speculator, the euphoric, can't-miss buying opportunity. After a long and sustained advance, a stock becomes the talk of the town. The newspapers are filled with bullish stories, the earnings are spectacular, and every analyst is predicting even higher prices. The amateur, feeling a powerful surge of greed and the fear of missing out, finally jumps in, buying with both hands at what feels like a moment of absolute certainty. This, for the practitioner of the opposite principle, is a moment of extreme danger. The professional does not feel greed at this moment. He feels caution. He recognizes the signs of a climactic run-up, the final frantic stage of a bull move where the public is brought in to take the stock off the hands of the insiders who have been accumulating it at far lower prices. Instead of buying at the peak, the opposite principle teaches the speculator to learn to recognize the signs of distribution. He sees the churning volume, the failure of the price to make further progress despite the bullish news, and he understands that the smart money is now selling. The opposite action is to sell what he holds, or to refrain from buying altogether. Consider the speculator who is already in a profitable long position. His natural impulse as the stock soars into the stratosphere is to become even more bullish, to congratulate himself on his genius and perhaps even to buy more. The opposite principle forces him to ask a different question. If this is the moment of maximum public excitement, is this not the greatest possible opportunity for me to sell? He learns to sell into strength, to liquidate his holdings when there is a broad and eager market to absorb them, not to wait until the trend has turned and buyers have vanished. Now, let us examine the other side of the coin, the losing position. The average trader buys a stock and it begins to decline. His first impulse is one of denial, followed swiftly by hope. It is just a temporary reaction, he tells himself. It will come back. When the price falls further, his hope becomes more desperate. He may even be tempted to buy more, to average down, a practice Livermore deemed a cardinal sin. This path of hope is a well-trodden road to ruin. The opposite action is immediate and brutal. He must learn to cut his losses. Instead of adding to a losing trade, the opposite principle demands that you eliminate it. The moment a trade goes against you and proves your initial judgment wrong, you must sell. There is no room for discussion or hope. The market has rendered its verdict, and you must accept it. This is perhaps the most difficult of all disciplines to master, for it requires the speculator to admit a mistake, to accept a small certain loss, and to override the powerful human desire to be proven right. But it is the single most important action for capital preservation. Instead of holding on and hoping for a rebound, the opposite trader acts on a healthy and rational fear. He fears that the small loss he is currently facing could grow into a large, crippling one. This fear motivates him to act decisively, to amputate the losing trade before it can infect his entire portfolio and his psychological well-being. He does not ask, "What if it comes back after I sell?" He understands that the risk of it not coming back is far greater and far more dangerous. This leads to the next practical application, the interpretation of market reactions. The amateur holding a profitable position sees the first sign of a pullback and is seized by fear. He sells immediately, snatching a small profit, afraid that the entire gain will evaporate. The professional, in contrast, has learned to wait, to observe the character of the reaction. He knows that a natural reaction is a normal part of a healthy trend. The opposite principle comes into play after the reaction. The amateur, having sold in a panic, now hopes for the stock to decline further so he can buy it back cheaper. Or, if he held on, he hopes desperately for a quick rebound. The professional does not hope. He watches. He waits for the market to give its confirmation. Does the stock rally after the reaction? Does it do so with vigor and on good volume? Does it push through to a new high? If so, the trend is confirmed and his position is sound. But if the rally fails to materialize, or if it is weak and feeble, the professional recognizes this as a definitive signal that the upward momentum is gone. The opposite of holding on and hoping is to sell immediately. He does not need to know why the stock has lost its strength. The fact that it has is all the information he requires. The failure of the market to confirm the continuation of the trend is his cue to exit, preserving his profits before a minor reaction turns into a major reversal. Opposite day trading, then, is not a literal system of always doing the reverse of your first impulse. It is a profound psychological training tool. It is the practice of using your own flawed emotional tendencies as a contraindicator. It is about building a mental firewall between your feelings and your actions. When you feel overwhelming greed, it is a signal to become cautious. When you feel desperate hope, it is a signal to become fearful and act to protect yourself. When you feel panic, it is often a signal that the moment of maximum opportunity is near. Through this constant practice of questioning and acting contrary to his natural impulses, the speculator begins to forge a new set of habits. He slowly kills the gambler within and cultivates the mindset of the cold, detached professional. The discipline of cutting losses becomes second nature. The patience to wait for a true, confirmed opportunity replaces the anxious need to be in the market at all times. The focus shifts from the thrill of action to the business of making money. This approach inherently protects capital. By refusing to average losses and by cutting them short, the speculator eliminates the possibility of the catastrophic drawdown. By refusing to be drawn in by euphoria at the top, he avoids becoming the bag holder for the smart money. His capital remains intact, his mind remains clear, and he is always ready for the next real move. And in time, a remarkable thing happens. Through the relentless practice of acting opposite to his flawed instincts, the speculator slowly begins to retrain those instincts. The process of analyzing, waiting, and acting based on objective signals rather than on raw emotion becomes habitual. He finds that his judgment becomes sharper, his timing more precise. He is no longer fighting himself. He finally reaches the state that Livermore himself occupied. He finds himself naturally aligning with the great sweeping trends, not in opposition to them. He buys with the bull trends and sells with the bear trends, not because he is guessing, but because he has learned to read the market's own clear language. The opposite day trading, which began as a conscious, difficult act of self-reversal, has transformed him into a trader who is in harmony with the market's true line of least resistance. He has not eliminated his emotions, but he has learned to make them his servants, not his masters.